Hello, welcome to this week's Market Carver. I'm Andrew Thrasher, Portfolio Manager for Financial Enhancement Group, joined by Zach Unger, Portfolio Manager as well. This week, we have two topics to discuss for the market right now. We have a new Fed share that's been announced, and we've also had some really big volatile moves happen in precious metals, specifically looking at gold, and we're going to look at silver today. So that's where we're going to start. We had one of the largest, actually the largest decline in silver prices going back multiple decades. It was a massive hit on Friday and comes after we saw extreme strength in silver over the last month and a half. If you look at this chart, it goes back quite a distance, but if we look at the far right side, we can see where silver prices basically went vertical at the end of last year and the start of this year. They just continue to climb higher, getting over 100% above their long-term average, something that we really haven't seen since really the 70s. And then we started seeing silver prices start to crash on Friday. And so there's a lot of different things traders are pointing to, investors are pointing to. It's being on the news. What was going on with silver? And this is what we talked about in the allocation meeting on Monday. And we always like to start with, we're not overly concerned with why something happens, but just seeing what the reactions of it are. But when we do look at the why, some of them for what happened to silver is we did get a new Fed share that caused this market to spook a little bit with Fed independence, which Zach's going to talk about next. But more importantly, what we believe is, one, there was exuberance in silver. It was getting extremely stretched and was ripe to see some kind of pullback at some point. And then whenever we start seeing liquidity get messed with within a market, it starts to have repercussions. And we saw that in silver, where the CME, who controls the futures trading, began to raise margin requirements for trading in precious metals. What that means is if you were to take out a position, to take out margin on to be long silver or be short silver, you have to put up a lot more money to do so. And they actually increased that requirement twice. And the last time was finally on Friday, and it was supposed to then go into effect the Monday of this week, saying, hey, if you're going to be long silver, because it's being so volatile, because its price has gotten a little crazy, we're going to require you to put a lot more money up front to take on that margin position. And that really, I think, is what kind of was the final straw. And we saw a big impact to silver dropping. You can see 27% by the close. It was down over 35% intraday, causing ripple effects across it. We saw it in gold, saw it in some of the precious metals, and then we saw it continue to reel on Monday, getting a bounce midweek, and we'll likely continue to see it be pretty volatile as a lot of the bigger investors try to even out what their positioning and risk management protocols are. The main takeaway for us, though, is we always want to recognize when we see a market like this, whether it's a commodity or a stock or an index, what have you, when it starts getting just crazy like silver has, where it's going vertical like that, we need to remember what our risk management protocols are and not try to get overly greedy chasing a trend like that. Because what can happen is what we saw happen in silver, and it's happened many times in other markets before, is that those that get overly greedy are the ones that get punished. And that we saw the repercussion again on Friday with a double-digit, massive decline, largest on record, going back again to the 70s. All right. That wraps up what happened in silver. We've gotten several questions about that. Hopefully that covers some of what maybe you're seeing in the news. Now I'm going to turn over to Zach, who's going to start looking at what's going on in the Fed.
Yeah, so as Andrew mentioned, we got news last week that Kevin Warsh will succeed Jerome Powell as the Fed chair when Powell's term is up at the end of May. You can see how the market responded from the chart on your screen here, the expectation of lower interest rates coming in. Over on the far right, where we see that sharp drop off in expected cuts by June and then subsequently by December, the market's pricing in steeper rate cuts. That's not unexpected. I think that's probably the most important take-home point for you guys. A lot of conversation out of the administration about the next Fed chair being more in line with what the White House wants to see from a rate cutting perspective. Obviously, have been a lot of calls for rate cuts, and the anticipation is that the new Fed chair would be much more aligned with that viewpoint than the current chair has been. How that flows through to the economy, should we see more rate cuts, how that impacts the economy, inflation, and then subsequently the markets, would probably be too speculative at this point to try and jump to conclusions. So we'll have to see how all of that plays out when the new chair starts his term and begins to implement some of these things. The Fed independence that Andrew alluded to is very important, particularly as it relates to the longer end of the curve. And those longer dated rates are correlated more to things like mortgages. So Fed independence, the more independent the Fed is, typically the lower those rates are going to be because there's less concern from investors. When they're not sure if the Fed's going to be independent, the rate required tends to be a little bit higher. In addition to cutting rates, one of the things that Warsh has talked about is having a smaller balance sheet, which would mean that the Fed is selling some of the assets that they hold on their balance sheet into the market. And that also can put upward pressure on the longer end, meaning a little bit higher rates. So at this point, we have some expectations for what the new administration is going to try and implement, or at least the new Fed chair is going to try and implement. It's going to be much more in line with what the administration has called for so far. How that impacts the overall market, though, remains to be seen, but not unexpected to see alignment between the new Fed chair and the White House.
All right. Thank you so much, Zach. That wraps it up for this week's Market Carver. As always, if you have any questions or would like to schedule a meeting, you'll see our website and phone number on your screen, as well as a QR code. Always happy to set up those meetings with our team. We look forward to bringing the next Market Carver next week. Have a good weekend. Bye.